Visa, ticker V, is currently trading at $275 per share, and over the past 5 years, the company is up by almost 70%. Now, most of you are probably familiar with Visa, most of you probably use it as your credit card or debit card if you don't use MasterCard. That is also the reason why today I want to have a look at Visa's financials, Visa's history, and calculate its intrinsic value to figure out whether it is a good idea to buy it at its current trading price. Now, to figure out its intrinsic value, we will use my stock valuation spreadsheets, which I have a link to down in the description of the video. You can check it out at my Patreon if you find it helpful. Now, let's jump straight into this valuation. Right away, we can see that the PE ratio of Visa is sitting at 33.76, which means that the company is currently trading at a premium. Now, the fact that the company is trading at a premium means that you will be paying more for the earnings of the company than you would for the earnings of most other companies. But that is quite understandable as Visa is a well-established company. Now, when we jump to tip ranks and go to analyst forecasts, we can see that the company is currently rated as a strong buy, with 23 out of the 26 analysts rating it as a buy, only 3 rating it as a hold, and 0 rating it as a sell, with an upside of almost 13% in the next year of $310, with the highest rating sitting at $335 and the lowest rating sitting at $265 within the next year. Now we can also jump to the dividends and have a look at the dividend income of Visa over the past few years. Now we can see that the current dividend yield of Visa is very low, sitting at only 0.71%, with a dividend payout quarterly sitting at $0.52 per share, which means that per year per share you'd be getting about $2.08 for every share you own of Visa. Now we can also see that the payout ratio of Visa is sitting at 21.54%, which is a very good payout ratio, and it basically allows this low of a ratio allows the company to invest almost 80% of its profits into buying back shares, paying off debt, and overall expanding the company. Now we can also have a look at the graph below. We can see that on May 2021, the dividend yield of the company was sitting at 0.56% and the dividend income was sitting at 0.32%. And now at the current time, it is sitting at $0.52 per share, which is very nice, showing just how well the company is doing. Now I also want to have a look at Visa's revenue by geography versus MasterCard's revenue by geography. As we can see, 46% of Visa's revenue comes from the US and only 18 and 17% come from Europe and Asia. Whereas for MasterCard, 33% comes from the US, 30% comes from Asia, and 27% comes from Asia Pacific, which splits MasterCard's revenue into 3 equal thirds, while almost half of Visa's revenue is based in the US and only about 40% is based in Europe and Asia Pacific, with Latin America being very similar for both countries. Now for MasterCard, this lowers the chance of a large stock price decline as it is not as attached to a single market as Visa is. Now, taking this into account, we can jump over to my stock valuation spreadsheets where we will simply plug in the ticker symbol of Visa and all the metrics will show up automatically. Now, as we have already gone through these metrics, we'll jump straight over to the 9-pair analysis. And we can see that only 2 of the 9 fields are in the red, and these are the 5-year PE ratio and the price to free cash flow over the past 5 years. Now, as I've already mentioned before, Visa should be trading at a premium, so this isn't a big of an issue. But let's have a look at the revenue growth over the past 5 years, which is sitting at almost 10% yearly, with an increasing free cash flow of 12.5% yearly, and decreasing shares outstanding, which basically means that with time you own a larger percentage of the company yourself. Now looking over to the long-term liabilities over the 5-year free cash flow, negative dividends that should be below 3. Currently it's sitting at 0.5, which means that Visa can pay off most of its current liabilities within 2.5 years with their current free cash flow. Now we can jump to the first valuation model, which is the Grams formula revised. Here we take the Grams formula revised and we get an intrinsic value of $129.84. Now the issue here is that the current yield on AA corporation bonds is quite higher than the short-term average, which would be sitting at about 3.4. So if we do plug that in, we get an intrinsic value of $196.29, which is still 40% lower than the current trading price of the company. Now we can jump to the discounted cash flow analysis, where we plug in the free cash flow over the past few years and get an average growth rate of 16.57%, with analysts projecting growth rate of 10.5% over the next 5 years. Now I project a growth rate of 12%, and when I plug that in, we get the future free cash flow over the next 10 years and the terminal value. Now to account for inflation, I want to calculate the present value of that future free cash flow, and I will do that using the discount rate. Now the discount rate is the percentage you would like to gain from your investment. But personally, I like to base the discount rate on the WACC, which is the weighted average cost of capital. Now we can see that that is currently sitting at 7.83. So I will plug in a discount rate of 8%, which I think is very fair for Visa. And we get an intrinsic value of $387, which is quite higher than the current trading price. Now, we will skip the multiples valuation model, as the only company we can really compare Visa to is MasterCard, and we've already kind of done that. And we will skip right to the dividend discount model. Here we take the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 15.28%. Now I project a growth rate of 13% over the next few years, and when I plug that in, we can see that the intrinsic value comes out negative, and that is because the projected growth rate cannot be higher than the current weighted average cost of capital of the company. And therefore I have my alternative model, which bases the intrinsic value on the next year's dividend and the stock price next year predicted by analysts. Now, having the intrinsic value of $280, we can go to our ultimate valuation, where we average out the grams valuation, discounting cash flow valuation, and the alternative dividend discount model valuation, and get an intrinsic value of $287.74, which is 4.63% higher than the current trading price of the company. Now, if I plug in a margin of safety of 20%, we get an acceptable buy price at $230.90. But as Visa is a well-established company that isn't going anywhere anytime soon, we can plug in a discount margin of safety of 10%, and we get an acceptable buy price of $259. Now, going back to our stock screener, we can see that the 52-week low of the company is sitting at $216. I do believe that the company will drop below $250 within the next few months, and that's personally when I will buy the company. Now, if you have enjoyed the video, make sure to leave a like and let me know down in the comments which company you would like me to evaluate next.